Biden to float historic tax increase on investment gains for the rich. If you have more than $1 million in capital gains, you may be considering realizing those gains this year. That's because President Joe Biden is expected to release the American Families Plan. That's right, folks, the American Families Plan, which includes a provision to almost double the capital gains tax rate for those earning in excess of $1 million per year. President Biden has proposed a near doubling of the maximum federal rate on capital gains or investment held more than 1 year to 43.4%. That's right, ladies and gentlemen, 43.4% to help fund the $1.8 trillion in new spending initiatives that include child care, pre-kindergarten education, tuition-free community college, and paid family leave. That would be the highest tax rate on investment gains, which are mostly paid by the wealthiest Americans since the 1920s. The rate has not exceeded 33.8% in the post-World War II era. Any such hike would need to go through Congress, where Biden's Democratic Party holds a narrow majority and is unlikely to win support from Republicans. It is unclear if it would have the unanimous backing of congressional Democrats, which would be essential in the Senate, where each party holds 50 seats. If it had a chance of passing, we'd be down 2,000 points, said Thomas Hayes, chairman and managing member of the hedge fund Great Hill Capital. They're popping Xanax, hitting the bars hard. The hedge fund managers are a little nervous, talking about the stock market indexes. After the news broke, the Dow Jones Industrial Average dropped more than 300 points, and market fears of an increased capital gains tax on investors. The question on everyone's mind being to sell or not to sell. That's the toughest question. That's what we all struggle with in the stock market. With the 2020 tax filing season still in full force and questions surrounding what the tax rate might look like in 2021, you might be contemplating realized capital gains sooner rather than later to avoid the tax hit in 2022 and beyond. However, if you're an investor, should you be running for the door? If you sold your business in 2020 and 2021, should you forego an installment sale? If you invest in real estate, should you reconsider deferring capital gains by investing in qualified opportunity zones? I invested in qualified opportunity zone a couple of years ago. That is an option. As of now, it's unclear if Democrats can pass these proposals through the slim majority in the House and Senate. However, with millions of dollars in tax at stake, it's important to discuss the likelihood and potential impact of capital gains tax hike. So what are the odds of this passing? If you were closely following then President candidate Joe Biden's tax proposals, it would come as no surprise to you that raising the capital gains tax rate would be one of the centerpieces of his platform and policy initiatives. On the campaign trail, Mr. Biden did not have a comprehensive tax agenda, but instead spoke the proposed tax increases as a way to pay for new spending programs. For example, the latest infrastructure bill that everyone's been talking about would be paid for in part by an increase in the corporate tax rate. Likewise, the latest proposal would use an increase in the capital gains tax rate to pay for child care and universal paid family leave. The spending and the tax increases come as a package deal, unlike previous tax legislation like the Tax Cuts and Jobs Cuts, the TCJA, was passed by the Republicans in 2017. Given this interplay, it's unlikely that any Republican would vote for new spending programs after passing more than $5 trillion of the COVID relief bill this last year. Even more so, the odds of a single Republican attaching his or her name to a tax increase of this magnitude would be near zero with an election year coming up, 2022. Therefore, there are only one of two ways this tax increase can become law. That's number one, budget reconciliation. The budget reconciliation process allows lawmakers to sidestep the Senate, filibuster, and expedite consideration of certain tax spending and debt limit legislation with a simple majority. Generally, this power is limited and can only be used once per fiscal year. And guess what? Democrats already used the process to pass the American Rescue Plan. So the next time they can use it is in fiscal year 2022, which begins October 1st, 2021. Another option is filibuster reform. Both parties have been talking about this. Eliminating the filibuster in the Senate would allow Democrats to pass legislation with a simple majority, but it would require the vote of every single Democrat senator. And Senator Joe Manchin, Democrat of West Virginia, has publicly come out against any proposal that would change the filibuster. So what are the odds of a capital gains tax increase passing, given the tight majority in the House and Senate and the unlikelihood of a filibuster reform? It is highly unlikely that the capital gains tax would almost double retroactively as of January 1st, 2021. However, it's been a crazy year, and we've seen crazier events unfold over the past year, so we can't rule anything out. More likely, though, if the Democrats are able to pass an increase in the capital gains tax rates after October 1st, 2021, it would take effect prospectively as of January 1st, 2022. So some tax planning strategies. If you think capital gains tax is inevitable, then there are several tax strategies to consider. Number one, loan harvesting. Tax loss harvesting is a great way to reduce taxable tax gains, especially if you expect rates to go up. Tax loss harvesting works by selling investments that are down, replacing them with similar investments that do not trigger the wash sale rule, and then offset recognized investment gains with those losses. This amounts to kicking the can down the road, just like we do with the spending bills, but hopefully the road leads to, a tax year when the capital gains tax rates are lower. And it's never too early to start thinking about harvesting tax losses, especially since losses can occur throughout the year. So call that accounting. Accelerating capital gains, although tax rates on capital gains may become retroactive to the beginning of the year, it is unlikely that Congress would penalize taxpayers who expected a 20% rate only to have Congress move the goalpost at the end of the year. Who would have thought? Both parties love to move the goalpost. So if you expect capital gains to increase in 2022 and not 2021, then it might be a good idea to accelerate some capital gains into 2021. If you're looking to cash out an investment that has done well, or sell your business before the end of the year, then now is the time to start planning. So pass on installment sales. An installment sale allows taxpayers to defer capital gains until the cash from the sale is actually received. So for example, if you sold your business in 2020, but you paid out over 5 years, then you can recognize those gains proportionally over 5 years. However, if you really think capital gains tax rates will go up in 2021 or 2022, then electing out of the installment sale treatment and paying the tax refund may be an option. So Section 1202, qualified small business stock. Section 1202 rewards investors who invest money into startup corporations by allowing them to exclude some or if not all the gain from the sale of the qualified small business stock. So gains from the sale of the QSBS acquired after September 27, 2010 and held for more than 5 years are eligible for 100% exclusion of up to a greater of 10 million or 10 times the basis. This means that even if the rate on the capital gains tax goes up, the QSBS investor can avoid the tax entirely. Qualified opportunity zones, I like these. Got to hold them for 10 years. If you invested capital gains in a qualified opportunity fund, QOF, then you have deferral of such gains until December 31st, 2026. Should you sell that investment and trigger the gain now before the rate goes up, or wait out until the next administration? There's no telling what the world or the capital gains tax rate will look like in 2025 or 6. However, prematurely point out the funds. This is it. In a QOF can end the party before it ever begins. If you can stick it out for 10 years, then that QOF investment can be sold tax-free. If you think rates will be higher next year, then you probably don't think they will be any better 10 years from now. So hold on to it for 10 years. Think before you act, before rushing on to make any major investment decisions based on policy proposals or news headlines. You should talk it through with your tax or financial advisor. Tax rates will eventually go up. So it's important to craft an intelligent tax strategy going forward. Odds are, if you are sitting on a few million in unrealized capital gains, you are good at making predictions. So what's the answer? to sell or not to sell. You know, Biden has proposed not to raise taxes on households earning less than $400,000 a year. Makes me nervous. Ladies and gentlemen, the real money is in the 152,000 people that work in the United States of America. So when these bills go through the House and the Senate, they get changed by lobbyists. So if you think Walmart is going to pay all this tax, what is Walmart going to do? They're going to pass it off to the consumer. So they're going to pass it off to the consumer. That means products are going to be more expensive. There are some checks and balances there, but that's what happens. Google reroutes everything through Ireland. They don't pay any tax. So my concern is that, and it's going to come down, trickle down to the working class. So we'll have to see what happens, how this all shakes out. But talk to your tax planner, talk to your financial advisor. This stuff's important to get ahead of it right now. These are interesting times with all these moving parts in the world. With COVID is throwing a wrinkle into it. So hope you enjoyed the talk. Take care. Be creative.